Well, U.S. natural gas front-month futures extended their decline on Monday, sliding toward a test of the $3.40 level as increasingly warm weather forecasts continued to weigh on sentiment. Above normal temperatures are expected to dominate the eastern two-thirds of the country from January 7 to 11, with the warm pattern expanding into the north-central U.S. during January 12 to 16. This setup points to softer near-term demand. Over the weekend, weather guidance trended even warmer across the January 6-15 window, further delaying the return of colder air by another 1 to 2 days. Current projections now suggest any colder push would not arrive until roughly January 16 to 18 and would be less intense than previously indicated. This shift triggered aggressive selling at the start of the new trading week. While the data still hints at colder air eventually moving back into the U.S., confirmation remains limited and further evidence is needed before the market reassesses demand risk. Meanwhile, the storage picture continues to worsen, with the surplus now projected to climb to around 192 billion cubic feet by the end of January, a rather impressive number for what is supposed to be the heart of winter. Under normal circumstances, a surplus like that would have prices calmly drifting somewhere near the $2 level. Instead, the market remains propped up by enthusiasm over higher LNG exports that might materialize in the second half of the year, as some larger traders appear perfectly willing to ignore today's oversupply in favor of tomorrow's possibilities. In reality, it would take a truly severe February cold spell to push storage levels even briefly below the 5-year average. If that cold once again decides not to show up, the market could be rewarded with a rather impressive sell-off, sending prices back below the $3 threshold, where the current fundamentals have been pointing all along. Natural gas remains technically vulnerable as the broader structure continues to favor the downside. The recent breakdown below the $3.50 area has reinforced bearish momentum, with price now gravitating toward the $3.40 zone. This level represents near-term support, but it is already showing signs of strain as selling pressure remains persistent and rallies continue to attract fresh shorts rather than new buyers. If $3.40 fails to hold on a closing basis, the next downside targets come in at $3.20, followed by the psychologically important $3 level. A decisive break below $3 would likely accelerate liquidation, opening the door toward the $2.90 region, where longer-term demand may finally begin to emerge. On the upside, former support in the $3.50 to $3.60 range has now turned into first resistance. As long as prices remain capped below this zone, any bounce should be viewed as corrective rather than a change in trend. Stronger resistance sits near $3.90, aligning with key retracement levels and short-term moving averages. A sustained recovery above this area would be required to neutralize the bearish technical outlook. Momentum indicators continue to favor sellers, with no clear bullish divergence evident at this stage. Unless a meaningful cold-driven demand shock materializes in February, the technical setup suggests that the path of least resistance remains lower, with near $3 pricing increasingly plausible in the weeks ahead. Don't forget to drop a comment, and feel free to buy me a coffee or YouTube super thanks if you'd like to help keep this channel going. Thanks for being here and I'll see you in the next one.